Hedge fund titan Ray Dalio saying that the bond market turmoil could be a more severe shock to the monetary system than the great financial crisis. Joining us to discuss all of this, Barry Knapp, Director of Research at Ironsides Macroeconomics, Stephen Davis, Senior Fellow at the Hoover Institution, and Steve Liesman is still with us as well. I'm delighted to say a very good afternoon to all of you. Stephen, I wanted to come to you first because all of this has created a lot of uncertainty. We think a lot of that uncertainty has been revealed by the markets and they've now bounced. But you've got a chart for us that kind of shows the scale of the uncertainty in financial markets compared to past crises, some of which we just mentioned there.
That's right. If you want to put it in perspective, current levels of U.S. economic policy uncertainty are running around the peak levels that we saw in the pandemic. If you focus on trade policy specifically, it's completely off the charts, unlike anything we've ever seen in the United States. So I think it's pretty clear that's what's driving the anxiety and the chaos, the term you used in the market. I'm very much on the same page as Janet Yellen and Larry Summers. The thing I would add is that economic uncertainty normally triggers a flight to safety effect that pushes the U.S. dollar up and Treasury yields down. Instead, we've been seeing the opposite recently. And I do think that reflects a loss of confidence in the capacity of the United States for sensible policymaking, hence the reference to kind of third world policymaking. That is very worrisome if it continues. In my mind, it is actually more worrisome than the direct effects of the tariff itself that you referred to that in your remarks about Governor Waller. So, yeah, this is a very serious issue. And the problem is that tariffs and economic policy making are subject to the reckless decision making and the whims of one man.
Barry, in terms of what we might see from here, clearly policy has changed in the last 10 days or so from the White House, pivoted based on whatever it might be that changes minds. The bond market, clearly one of those factors. What about the Federal Reserve? Do you think they are going to react, or they are willing to react if things get worse again from here?
Yeah, absolutely. I think Chris Waller is a pretty good benchmark for all of this. I do think the Fed will be easing policy fairly aggressively. I mean, we could look at last week's inflation data and the cyclical components, which is really what led to a softer than expected CPI or PPI. The markets have been telling us for months that this is more likely to be a negative growth shock than it is an inflation shock. I think the really important point here, Wilf, though, is as we think forward, and what really occurred last week is, and this is something I've been cautioning about for the better part of 2 years, but in particular recently, is that the trade policy could derail the most important policy objective for investors, which is to get government spending on a glide path back to its 50-year median, which is 20.5% of GDP. If we don't stabilize the debt, we will, all of this other stuff will just be, irrelevant. We could have a broader crisis, and that's, I think, a lot of what last week was about. And so there was a bunch of things that happened last week that kind of, slipped underneath the radar, so to speak. First is a technical measure blowing out of swap spreads, which is all about concerns about supply in the Treasury market. We had the Treasury and CBO report that we've run a $1.3 trillion deficit for the first 6 months of the year. And the House signed off on the Senate budget resolution that doesn't require any spending cuts. Now, they assert that they're going to do it, but the administration seems determined to try and partially tax their way out of our big deficit problem. And that never works because it'll slow growth. And the budget deficit, if he does indeed drive us into recession with this confidence shock that Professor Davis is talking about, the budget deficit blows out from 7% to 10% as sort of a standard, expectation of what would happen here. So for me, that's the real issue. Is this trade agenda derailing the more important, getting our fiscal house in order? My note this week was titled Made in America, and I'm not talking about products. I'm talking about $36 trillion of debt. We have to stabilize that, or none of this will work.